Welcome to the Board of Investments meeting. I'll formally call the board to order. And we'll start with a roll call, see if Savannah can do that again.
Good morning, Mr. Chair and members of the board. Jack Prothero,
Here.
Cindy Youngkin,
Here.
Porter Bennett,
Here.
Tim Kober,
Here.
Maggie Peterson,
Here.
Mark Berry,
Here.
Jeff Meredith,
Here.
Dan Trost.
Here.
Excellent. All voting members are present, forming a quorum. Thank you.
Thank you. So I did want to give the notice again that we're video recording this, so keep that in mind. And then I'll call for public comment. Is there any public comment from anybody with issues before the board's jurisdiction? Seeing none, we'll move on. Becky, I do want to report that Jim's behavior was very good last night, in case you're keeping track.
I was going to ask you, Jack. Thank you for that report. I appreciate
So with Becky looking over your shoulder there, Jim, I'll turn it over to you.
Thank you, Mr. Chair, and I will try to keep the metaphor budget to something short of, say, 20 or so.
You know, with me, it's unlimited.
And I so appreciate that after the entirely restrictive regime that I've had to do. So there's a lot of, one of the great things about, challenging things about institutional investing, but it's also interesting, is there's a stream of data that comes off a complex, diversified portfolio. And in that stream of data are storylines. And puzzling them out is one of the most interesting things that we do as consultants and that you have to do as part of your job as fiduciaries. So I'm going to be working, I'm going to try to do a lot of that today. And I'll start off by working from the executive summary and capital markets review, where you have two deliverables in front of you. This is the shorter one that's a little more condensed, but I will refer to the other one later on. So if I could ask you to turn to page 4 of the executive summary. The first thing I want to say is the punchline, and the punchline is two parts. One is the fund is doing well. And in fact, I wrote that down and then I crossed it out and I said, no, it's continuing to do well. Because the track record that this board and staff have laid down over now well over a decade is really quite extraordinary, and we'll see why that is. Second part of the punchline is there may be challenging times ahead. And we'll talk more about the nature of those. I have something called the Jack Prothero memorial page going forward that talks about risks and things to worry about. And so we're going to
Memorial page.
Yeah, it's a memorial page, yeah.
Can I ask a question, Jim? When you say troubling times ahead, is that specific to the Board of Investments?
Specific to institutional investors. Of which you are a classic example. In fact, you're more than a classic example because you not only invest a pension plan, but a trust fund and a workers' comp plan, as you well know, and so many other things. You are a archetypical institutional investor. So on page 4 of the executive summary, gave the bottom line, I wanted to make 2 comments. One is a quick one on the lessons that apply from the Silicon Valley Bank and the other bank failures to pension plans. Every institutional fund pool of assets has a purpose, and that purpose is usually ending up spending money, right, for some purpose. The difference between their ability to create, to liquefy assets to create that spending, to fulfill its purpose, and the investment strategy is always a tension. Banks, and I know the chair knows this all too well, live in the world of a constant asset liability mismatch. Deposits can be called the next day, but loans cannot be. In fact, loans can stretch on for a number of years. So Silicon Valley Bank did a particularly poor job of managing that asset liability mismatch. But it is at the heart of why when you hear your staff talk about, or RVK talk about keeping an eye on illiquid investments relative to the cash outflows of your portfolio, this is what it's all about. It has its roots in the asset liability paradigm that pervades all investors, all institutional funds. It just has each one, like a pension plan, is different than the one that faces banks, different than the one that faces insurance companies, but they're all essentially the same paradigm. So that's the lesson that I think we want to take away from Silicon Valley Bank. The second thing on page 4 is every time that there's a potential change in the world of trend lines and institutional investing, you want to sort of raise your hand and just point to it. And what you can see here is that for the first time in a long time being multiple years, international stocks, both large and small, did as well, actually did a little bit better than US stocks in the recent quarter and year to date. So that's an unusual item. Now, will it persist? Don't know. In our capital markets review, if one went simply by the numbers, it would persist because international stocks are cheap. But we also know that there's more event risk in the international arena. Than the US is still the world's safe haven. And the second thing, and more importantly, is you have to pay benefits in US dollars. So you, with our backing and recommendation, have always been weighted toward US currency based, not exclusively, because that would make you relatively undiversified as a global investor, but weighted disproportionately toward US currency based assets. So is this potential performance of international stocks helpful to Montana or not? The answer is yes and no. Yes, in the sense that it presents an opportunity for a diversifying asset to actually contribute more in terms of absolute dollars to your ultimate goal, which is to pay benefits. No, in the respect that because you are structurally overweighted toward dollar-denominated assets, it might hurt your peer ratings. But remember, we don't care as much about peer ratings as we do about paying benefits. So just a few comments sort of overarching about that. Interrupt me at any time with questions. Turning to page 5 and talking about big changes, obviously what the Fed is doing is echoing all through the economy and all through every part of the capital markets. And on page 5, I'll just give you a couple examples. When you think about economic growth, there's kind of an equation that economists use. And think of the equation as this: it's innovation and organization, which is how we use assets. We can use them better, we can use them worse, we can innovate, times the 3 inputs for economic growth, which are land, labor, and capital. What's happening now with rates rising is that capital, the cost of debt, but also the cost of equity capital, because as equity values are pushed down, that means that it's more expensive for companies to raise equity capital as well. So the cost of all kinds of capital has gone up. And what you see on the top chart on page 5 is predictably, we're seeing economic activity start to wane. It's actually waning fairly slowly, though. And the way that you can sense that is just by looking at things like the inflation rate is still high because there's still plenty of demand. We have not exhausted the money that we printed during the COVID era, which is still out there calling forth demand for goods and services. And the labor market has shrunk in terms of available labor so much that the unemployment rate is still quite low, very low, as a matter of fact. So let me turn to the bottom page, and you'll see how big how different the current circumstances are versus what we have invested in, what you have invested in the last 10 years. So I'm really looking at the column of numbers to the far left and the column of numbers to the far right. Let's just look at interest rates. It's amazing. Look at the 10-year average for the treasury market for the 1 year, the 10-year, and the 30 years, 1 to 2%, actually a little bit less than 1% when you think about the fundraise. That's on the right-hand side. That's the 10-year average. That's how low interest rates have been. I mean, it is amazing. Now, look at where we stood at the end of the first quarter of this year. These are significantly higher. Significantly higher. They may not be high relative to 30 or 40-year averages, but relative to the world that we've lived in for the last 10 years, these are monumentally higher. And you may recall that is in a response to this, at the beginning of this year, we raised our forward-looking expectations for investing in fixed income simply because the coupons are higher. It's pure and simple. Now, if you look at the next panel down, very interesting panel. The 3 rows called break-even inflation. We can look at break-even inflation just like interest rates over 5 years, 10 years, and 30 years. And this is the expectation that is built into the TIPS market by investors like yourself. When we subtract nominal, when we look at the difference between nominal bond yields and TIPS bond yields, which have inflation protection embedded in them structurally, we get a sense of the inflation that investors who are buying TIPS expect. Look at how low it is. If you look at the far left-hand column, it's like 2.5%, 2.3%, 2.2%. This is one of the reasons why we didn't move our inflation number up to 3 or 4 or 5, is the market is signaling across the board that that's not what they expect in the long run. Now, interestingly enough, those are higher than the ones on the far right, but they're not all that much higher. So either the market is dead wrong about inflation, in which case there will be a sort of a come to Jesus moment. But this has been a very persistent, if you look across, a very persistent phenomenon about what investors really expect in the long run for inflation. They do expect the Fed to win the battle against inflation, whether they win it because there's a soft landing or because they trigger a significant recession. Our view is that beyond that short term, there are lots of semi-deflationary factors in play, like substantial debt throughout the global economy, just to pick one, that are going to tend to suppress inflation. The last thing I wanted to point out in this panel was what's happened to oil prices. Again, 10-year average, only $65 on the far right-hand column, but we're ranging roughly between $78 and $82 in the oil market. That's a pretty significant change, both for, in fact, if you had divested from all of your oil stocks 2 years ago, this would have been a really missed opportunity. There are more than a few, particularly university endowments, who have. And I think that they're saying that in the long run, that will be a good decision. In the short run, it's been a very poor one. So that's any questions on the economy or where we stand today versus what we've lived in for the last 10 years? Yes, sir.
You said that you think that decision relative to oil is not maybe a good one in the long run?
No, well, that's what the divest oil advocates argue, that they think that it's going to be a good decision in the long run because oil demand's going to plummet, and regulations are going to make it very difficult to supply oil, and that means that non-fossil fuel energy will dominate the landscape. It's hard. We're not energy experts per se, but it is rare that you see a transition of such a fundamental nature where oil is present, as Ethan pointed out yesterday, in almost everything we touch, or natural gas, that it should happen so fast. But people have to pick their poison, and they did. So
how about us?
how about
this, the state's investments, or do we still have a lot in oil type things or not?
Yes, the answer is yes, and for good, and for very thoughtful, deliberate reasons. It's not a matter of accident, and it's paid off.
And that's those investments are expected to be continued for the foreseeable future? I mean, 10, 20 years?
I mean, I get, not to get too far off topic, but I guess I think our view is more that that transition is going to take a very long time, like, probably beyond my lifetime. And we will continue to use oil and gas. I mean, it's clear, everything you read, there is no easy fix here that you're going to make that transition. We can continue to scale solar and wind and other things, and all it's doing for the most part is, at best, you're running in place with oil and gas. And to Ethan's point, people tend to think of it as gasoline or something like that, but it's used in so many things that it will be with us for a very long time.
The numbers would support what John just said.
And as Ethan said, as they leave, as there's the states of Maine who have decided they're going to divest, leaves a better opportunity set for us. And I'm more than happy to dine on their carrion.
Thank you.
So on page 6 of the executive summary, I mentioned that that the fund is continuing to do well, not only doing well, but continuing to do well. This is really the proof statement of that. And, the proof statement, I think, is that, I like to look at how are we doing with 3 different questions. One is, how is the fund doing in terms of what the actuary has decided to expect when they set contribution rates? And the answer is in the top row for 3, 5, 7, and 10 years. And you can see that those absolute return numbers are quite healthy relative to those expectations. That's a very good thing. This is a line that, a number, I should say, an outcome, where the market has a big say in what those absolute numbers are. Because you cannot engineer those numbers. Those numbers are what's available over these periods of time in the capital market, stock market, bond market, real estate market. And the question is, how much of it can you harvest, and harvest with prudent levels of risk? This is a good job. And what you can tell, the second is that the structure or the strategy that you put forward, you have benchmarks for it. We all know that benchmarks are range from pretty good to imperfect to as best as we can manage. But if you look at the third line down, you can see that over 10 years, over 7 years, over 5 years, over 3 years, not over 3 years, over 1 year, you have exceeded your expectations for your actual execution of your investment strategy. That's a good thing as well. Now we come to the last how are we doing way of looking at things. And that is, how are you doing versus peers? We give this the least amount of weight because peers have different liabilities. They have different contribution strategies. They have different circumstances. They have different trustees with different risk preferences. But if we just step back and said, okay, let's just look at how a large group of pension plans are doing and not put too much weight on it. The fact of the matter is that you're doing very well. If you look at the lowest row, what you can see is that you're consistently in the top quartile. And we did many years ago a study, we were asked, well, what is it going to take for us to get into the top quartile or the top decile? What does it take? What does it take? And so we did an analysis of public funds over 20 plus years. And what we discovered is that it's not folks that kind of shot the lights out in any particular year and then didn't do so well and then shot the lights out again. It's folks that were always above median year after year and never in the 80th or the 90th percentile. And it turns out that if you take a look at this lowest row, how do you get to be in the 3rd percentile? Almost the best performing public fund in this category. When none of these periods you're in the third profile. And the answer is that all these peers that are not as consistent as you kind of fall by the wayside, so that when you add up the 10 years, you rise to the top. And this is a very good track record. But I don't want to make too much of it because, I want to I don't want to talk out of both sides of my mouth. Peer comparisons are the least important. And we give you the how are we doing pecking order questions in the pecking order of importance in our judgment. If we can turn to page 7, we're going to talk a little bit about asset class categories. We are much more keen on the total funds performance and the performance of asset classes than any individual manager. There is no individual manager that can make or break this portfolio, but a bad asset allocation can, and a very poor asset class structure in one of your big asset classes can put a big ding in you. So in many ways, metaphor alert, you folks are like general managers of a sports team or like an executive producer of somebody who's putting on a play. You have a cast of characters, and the cast of characters need to be complementary. And what you're interested in is not having the best category, either player on the field in every single category or the best actor that you can cast. You want a happy audience at the end of the day and a long running play, or you want W's. And if you get the W's and you win the World Series, who cares that your shortstop only hits 220? Or your understudy in the play is okay, but not great. It's all about winning. And so what you're doing here is these are your teams, and you set the weight of the teams in your asset allocation, but your staff executes the strategy within each one using managers and sometimes internal management as well. So let me make a few comments about the asset classes, which after the total performance of the fund are by far the most important. One of the things I would say with respect to domestic equity is that you're mostly, in fact, you're almost exclusively passive at this point. And so what that means is that you're going to rise or fall based on the market, and you're going to accept the risks that the market gives you, whether you like it or not. This has been a good strategy for you, and you've actually, in recent years, sort of upped the ante on it. There will be times, and I will point out an example where asset classes, the index can actually underperform and be below median of all other folks trying to invest in the asset class. In fact, if you look at this, you can look that for the 1 year, your rank was 63rd. I wouldn't worry about that in the slightest because you have a strategy. It's a very low cost strategy. It's one particularly in large cap equity that we support very much because it's there's much lower probability of active management outperforming in large cap domestic equity, which is the largest part of your domestic equity portfolio by a wide margin.
Jim, quick question. So the ranking, is that net of fees?
The ranking has to be gross of fees because we don't know the fees of all the other components in it. That's why you see you'll see net of fees in many instances where we're just focused on you, but you'll see gross of fees when we have to compare to either lots of managers working in the same space or other funds.
And Mark, that's why we have the CEM overlay on it, so that we can see gross performance, but then how do we compare on a cost perspective?
Jim, when you say passive versus active, is the difference between picking companies or picking funds?
No, it's that when you have a passive approach to, say, U.S. equity, it means that you buy all the stocks in the universe according to some formula, and the formula doesn't really change. In most cases, the formula is by weighted capitalization. So Apple is huge, Microsoft is huge. In a passive index, you will own it in huge quantities, the same amount that it is weighted in the index. And then there are a lot of small stocks in the S&P 500 or the Russell 1000 that you will own tiny bits of. And that's executed for you by an external manager. In fact, you have several passive external managers. So, but there are other ways to be passive. That is by far the most common, by far. And it's very cheap.
So active means you're picking individual.
And active means that you're picking some of those stocks Either you're owning none of others, or you're owning less than the weight that they would have in a passive index. So you might own Apple, but you might own just a little bit of it, whereas the index owns a big piece of it. And in fact, there's a measure called active share, where if you're going to have an active manager in any asset class, you want them to be active because they're going to charge you more. And if we look at it and and the active share is very low, it means that they're basically just mimicking the index. So why not just own the index and pay a basis point or two rather than 30 basis points or 40 basis points?
So another question, so if, we're predominantly passive, wouldn't we?
In this area, you're
Yeah.
quite active in the portfolio as a whole. We'll
Right,
talk
right.
about that.
But wouldn't we expect to be in like the 50th percentile as far as rank?
Only if, only if you thought that 50% of the other players in this we're going to outperform the index and 50% were lower, but there's no reason to think that. So we have a study that we do and we update it every single year with the most recent year's projections. And it turns out that that ratio that you just talked about is hardly fixed. In some asset classes, active managers tend to persistently outperform the index. In others, like the areas where you're predominantly passive, many fewer managers outperform the index. So you wouldn't expect it to always be at the 50%. One of the reasons you moved to passive management here was, I mean, there were fees, there was the effort that had to be involved, but the index actually had many active managers that were lower. So the index ranked high for many years over this period.
And just for new board members, that transition from blended active passive to passive was in November 2021.
Sounds right.
Yeah, so it would reflect in the 3-year would be reflective of the blend. The 1 year would be reflective of just the passive portfolio.
And by the way, why did the 1 year rank turn out so low? It was because the cap weighted index was loaded up with weightings in the top 10 stocks, Microsoft, Apple, Netflix. I mean, and it was extremely concentrated. We talked about this at meeting. There are many pros to being passive in this area, but it's no free lunch. There still are risks. And a highly concentrated cap weighted portfolio has risk because if something happens to that small group of stocks, it disproportionately affects the index. And I believe that's why this rank for the index fell so sharply for this 1 year. And I could go down a rabbit's hole to talk about why that group of 10 got hurt so badly during rising inflation and rising interest rates. Has to do with discounted cash flow and all that sort of stuff for growth stocks. Any other questions about domestic? Otherwise, I'll turn quickly to international. International is an interesting animal in that there is a higher probability of actually outperforming the index, far from a guarantee. But you kind of see it in this panel. What you see is that your team in international equity, and by team I mean all of the exposures and managers and types of products that you put, have actually outperformed the index, but they have fallen well short of competing opportunities in the marketplace. And that simply means that there's a group of, and this, by the way, this comparison is as many folks as we can find that invest in precisely the same universe as yours. It's not just pension plans. It's also managers. And what we see here is that you essentially added value over the passive index. But there were folks that either took more risk, or maybe they were a little more skilled and they added somewhat more value. You shouldn't be too disturbed about that. You actually fulfilled your goal of doing better than a passive index over this period because you beat your custom index persistently over these time periods. And while these numbers may seem small, when they're persistent and they're applied to hundreds of millions, if not billions of dollars, those are very material additions to the portfolio. If I
So
can,
Jim, just on, because at least when I look at that, that's sort of long enough to say a trend is there on our rank.
Mhm.
Would you think that trend would continue going forward?
The answer is that it has been a long-running circumstance, and you can never say never, but the circumstances in the international market are still unsettled enough so that there's opportunity for active decisions to add value or not. Unlike the US large cap equity market that is so heavily researched, it's hard to have a different point of view and have a high likelihood of being right. And so if one looked at this, it is not unreasonable to think, Jack, that this is a trend that could persist for a period of time. The changes in the international equity market are not so profound that it's remarkably different than the era that we've seen here. If you were to be able to eke out 10, 20, or 25 basis points above the index, that would be a win over the coming period.
Jim, correct me if I'm wrong, but I look at this and I typically think that within the ranking, there's probably some managers or people in there that are, I don't know if miscategorizing is the wrong word, but they would have perhaps a global mandate, which would include some US exposure potentially in there. And that might skew the rankings because people don't always report in the most accurate fashion. But correct me if I'm wrong.
We think that was probably something that could have happened more often in the past. I think it's less often happened now. What is more likely, if there's a bias, is that there are managers in here that have differential opportunities to either use securities in the emerging markets, or they're either tightly constrained or they're very loosely constrained, or they make decisions within it. That might be part of this. I think that's more likely than the global category is now one that is more well-defined. Becky, would you agree with that, that in the past 5 years in particular, global US equity as a manager category and as an investment category has become much more formalized?
Yeah, it's really picked up some more mandates than it has in the past. There was a period several years ago where plan sponsors were really interested in global mandates, and then they decided to hire specialists in US equity and specialists in non-US equity. But that global trend, I think, is picking up some steam because plan sponsors have found it difficult to feel comfortable with their decision about how much to have in the US and how much to have outside the US, and want a manager to make that decision. So global mandates have picked up. And the other thing I would just state is when we look at these ranks, a lot of times it's been driven by, if you have more emerging markets than some active managers and you've carved out that as a specialty, and your total international equity portfolio has more emerging, in the periods when emerging has really struggled relative to the developed world, that has been a big source of that rank being lower. Obviously, that's no call on what the future holds, because we think there's great potential in emerging in the long term, but it's gone through a period of more muted performance versus the developed world. So emerging markets is certainly a part of this.
Great. Any other questions about international? I want to flip to fixed income, which is an interesting category. I want to call your attention that we're on page 8 at the very top panel, core fixed income. You know, as we entered the period or exited the period of very low, forcibly suppressed interest rates by the Fed, and they started to raise rates, one of the things that we said is that the first thing that's going to happen is all the bonds you own are going to fall in value. I mean, that's just the way it works, because they have to adjust to the higher rates of higher yields that are now available in the marketplace. The only way to do that is they have to fall in price. And so if you look at the 1 year for core fixed income, you know, this was an uncharacteristically bad year for fixed income. There are not that many years in which fixed income shows a loss, much less of this magnitude. So this was, we said that this was gonna happen. It really happened in spades for a long duration fixed income. And we also said, but the fixed income is a self-healing asset. That is, as bonds mature and roll over, you kind of eat the loss, but then you get to reinvest the proceeds at the now present higher yields. So take a look at your recent quarter. It has already started that process a bit. Now, that was helped a little bit by the fact that interest rates did back off a bit during this quarter. But the point still remains that you take the pain in fixed income up first, and then if there's benefit, it comes later. And this is also reflected in our capital market assumptions that you'll revisit again. You've seen them several times. You'll see them again when we collaborate with your staff on asset allocation, because they're an important element of that. And to make something like 2+% in a quarter for fixed income, it is the reason that we raised our expectations for fixed income. I mean, think about it. When the average annual return for core fixed income over 7 years, you see that number 0.91%. Well, this is another big change. Core fixed income is now actually contributing real dollars to the return of the portfolio. Not anything close yet to your assumed rate of return, but a huge difference and getting much closer. There is I want to talk a little bit about non-core fixed income, which is right down below. This is an area where I suspect that John and staff are monitoring this pretty closely. You have historically, and you can see the rank numbers, for example, there. And by the way, ranks mean a little bit more in the asset class world than they do in the total fund world. Because in the asset class world, we're getting a better comparison against other folks that are trying to do very much the same thing that you're doing. Maybe not quite the same, but much closer than in the total fund world. And you can see that the ranks are quite low. This is because your strategy has been to heavily weight non-core fixed income that is on the very conservative end of the scale, particularly high yield. During periods of very low yields, very low interest rates, defaults are very low. So high yield managers could take a lot of risk, and high yield issuers could always, if they got in trouble, get more money and get it cheaply. And so the conservative approach, while we think was very prudent, it lagged behind some of the riskier approaches. Recently, you've entered into this category into a new area. Your staff is doing a lot of sort of work in this area, and that is preferred securities. Preferred securities are titularly equity, but they behave a lot like bonds. And so, and the timing of the entry was very similar in nature to when this fund entered into real estate at a not particularly great starting point time. So if you look later on in the big book, you'll see that the preferred securities allocations are off to a very poor start. But it's very short term. And if you recall, in the area in the real estate example, real estate turned out to have a very tough starting year, and then proved to be a really big additive to the portfolio and continues to be, particularly in the last couple of years. So don't take my remarks as why in the hell did you get into preferred securities? The timing just wasn't propitious. But what it does mean is that this is an area.
I don't know the difference between core and non-core. What do you mean by that?
Core fixed income is, you might think of it as plain vanilla fixed income. Corporate bonds, treasuries, and I don't want to use the word exotic because it doesn't quite fit. But when you get into things like high yield, so low rated credits, but with much higher yields, and some people think emerging market debt is another example where you have.
That's an example of non-core.
Those are examples of non-core, yeah. They tend to be riskier. They tend to have higher yields and higher returns. Did you have anything you wanted to add to that, John?
I'd just say core is investment grade. For us, core is investment grade, fixed income. Barclays Ag, non-core is mostly high yield, non-investment grade, and then EMD and some other things.
But preferreds or securities are in that bucket.
Preferred securities are in that bucket because they also have a coupon like a bond, but to Jim's point, they're kind of a hybrid, equity.
But are they
equity
higher
index.
risk?
They're higher risk than investment grade, sure. Absolutely.
Yeah, they differ in several respects. One of them is that they tend to be perpetual, unlike a bond which matures and you get your money back. Although they don't have to be perpetual. And the second is that in the event of bankruptcy, bonds are higher, equity is lower, preferred is kind of in the middle. So they're in that respect, they're riskier than bonds too.
I'm sure Jason will point this out later, but the preferred space has a very different sector weighting, so it's very heavy in financials. We know what happened to the banks the last quarter or two here. That's a big reason why preferreds got whacked pretty hard.
Okay.
And it was not an easy thing to see that the starting point was going to, in fact, I think it was impossible to see that the starting point was going to be a poor one. The real assets, I'm not going to go into this too much because you had a deep dive with it with Ethan. I thought Ethan's presentation was spot on. Obviously, I joined in on a number of the points that he made. And it is a real diversifier. It is one of the inflation hedges that you have. We're going to talk a little bit more about inflation in a little while. Real estate, this is an area that's under significant change. What a surprising asset class. As we entered COVID and center cities emptied out and people weren't going to retail stores, institutional investors and the press and everybody dumped on real estate in its entirety. And it was wrong. It turned out that it was right with respect to commercial properties and retail, but they even missed the point that many of those leases ran on for a number of years and either had to be paid or defaulted on. And most lessors did not want to, or lessees did not want to default on them. So the cash flows weren't as bad as people thought. Number two is that there were other parts that were less visible to people and to the press of the real estate market that did really, really well. Logistics, warehousing, medical properties. I mean, you can go on down the list. They were superlative. And so at the end of the day, during COVID and in the immediate aftermath, real estate was not sort of the problem child. It was a savior for many diversified portfolios. And you can see that in your 1 and 3 year numbers for absolute numbers in the middle of the page. It's the blue line going across. Things have changed though, in the sense that those values in the favored sectors of real estate are now well known. But now the center city values, particularly the CBDs of the big cities where there's a lot of real estate exposure in the indices, is really under pressure. And we're going to see some transactions, I suspect, that's what our real estate experts at RVK say, that are going to be kind of eye-poppingly low. So you can already see that the markdowns are starting to occur, plus the fact that the cash flows from all types of real estate now have to compete with the cash flows from bonds, which are higher, and from cash, which is higher. So the real estate is turning from surprise positive for diversified investors to, well, this will be more challenging. And it is the only asset class, you may recall that at the beginning of this year, it was the only one where we downticked our forward-looking return expectations for all the reasons I just went through. Any questions about real estate? Otherwise, I want to make one quick comment about private investments, which are mostly private equity in your case. And, private investments, I have to tell you, because the fees are higher, because they are more opaque, they're harder to understand by constituencies across the country. boards are under attack for engaging in this kind of investment. And yet boards and their staffs are fighting back saying, this is crazy. After we pay all the fees, we're netting more money for our funds than we would in almost any other asset class. The way to look at this is not to look at it for any particular quarter or fiscal year, because these are 10+ year investments. Let's move out and look under the private investment column, and let's move out to the 7 and 10 year. So we're looking at a period of time that is more relevant to the nature of the investment that you're making. What are we seeing here? We're seeing that the returns are double digit. We're seeing that they are noticeably higher than the public markets, because the public markets are embedded in your benchmark. There's no such thing as a relevant rank here. But this has been a successful area for the fund, and it is, along with equity itself, probably the two key return drivers. Take this out of the portfolio, and you have a quite different challenge trying to achieve your assumed rate of return that your actuary has set contributions based on. And that means that contributions are more likely to rise, not fall. Yep.
Just a quick question. Do you include hedge funds in private
No.
equity? Or
No, hedge funds, totally different.
Okay, so where would they show up?
We don't have any hedge funds.
You don't have any hedge funds, and there are no hedge funds in this category. Cash, it's gone from being a zero return asset to returning 1% a quarter or more. Now, 1% a quarter or more, you compound that up, it's getting close to 4.5%, 5%. All of a sudden, you have the luxury of holding some cash. The challenge is, don't hold too much or for too long, because everything comes with a risk, and cash's risk is reinvestment risk. Because cash returns, those securities, many of them turn over in a couple of days. And certainly the majority of them turn over in a year. And so what we're talking about is that if you are not careful about making sure that enough of your assets are in longer dated risk assets, whether that be bonds or real estate or stocks, you could end up, if there's a big recession and the Fed cuts rates back down to zero, you could end up holding cash that once again is holding zero, and you're late to the party. We don't like to time the market, so what we recommend is be careful that you don't overuse the luxury of having cash that now has a return, because there is a sort of I don't want to call it a hidden risk, because it's not hidden to professionals like everybody in this room, but it is a risk. Reinvestment risk is a real risk, especially when you're a perpetual fund. So I'll stop there. Don't have too much to say about the other two areas. They are very much derivative of what I've talked about. Do I have a little bit more time, Mr. Chair?
You certainly do.
All right. So let's turn to page 11. I want to make a couple of points here. The first one is lower left-hand corner. I want to make the point that you've heard me make probably a few times before. Take a look at the 1-year number, and these are the indexes and for the major asset classes. Look at the red. The only black one is short-term cash. Everything else got whacked. This was the period of time when the Fed was raising interest rates. We'll talk about that in a minute. And inflation was eroding the future values of cash flow. And every investment that anyone makes has value only to the extent that it can produce a stream of cash flow, unless you never want to actually spend any of the money, which you are required to do every month, if I recall. So every asset class, no matter what it is valued on the cash that it can produce over time. There are some other factors involved as well, like how liquid it is and how easily tradable and other characteristics. But so the message to take away here is that we haven't had this happened to us since the late 1970s. I'm the only person in the room that was actually in the investment world during that period. And it was the worst investment period you can imagine. And I'll talk just in a moment a little bit about that when we look at the inflation charts. But the next time you hear somebody say, you know, if we could only get inflation up from this 1 or 1.5%, things would be better. You should just, well, I want to be careful what I say because the meeting's being recorded. So on the right-hand side, the right-hand panel, I'm thinking that we should make this chart a little less busy. I'm just going to point out this, by the way, let me tell you what this chart is. This is the interest rate in the treasury market that prevails for an instrument that matures in each different length of time. So some of them mature in 3 months, some of them mature in 30 years, okay? And these are these lines represent where the rates are for instruments that have this duration. So I only want to point out 2 of them. One of them is the brown one, the March 20, when we were in the middle of COVID, and it's the very bottom one, and it has a kind of a nice upward slope, which you would expect, right? If you want to lend money for a longer period of time, hey, I want a little more interest if my money's going to be at risk. But the other characteristic of it is that the first 2 years are virtually at 0 because the Fed forced it to be there. And in fact, they forced the other ends to be down by buying bonds hand over fist at those durations as well. So that was the world of ZIRP, zero interest rate policy, and quantitative easing, QE. Now let's move to the most recent one, which is the green one, March 23rd. Couldn't be more different. The yields in the treasury market on which the bond yields for other types of bonds, you asked about non-core bonds but all types of bonds, corporate bonds, are set often in reference to treasury rates. And so that green line, if you can ignore all the other ones, totally different shape and much, much higher. Totally different shape. And I want to call your attention to the shape in particular, because unlike this, it's like this. And that inverted yield curve has been one of the most, not perfect, but one of the most dependable indicators that either a recession is coming or the Fed's going to change its mind completely and start driving down rates again, just for its own reasons, which I find that hard to believe given where inflation is. So the bond market looks like it's expecting some combination of economic weakness, whether you call it a recession or not, and a Fed response to that of some sort, i.e. stopping raising rates or maybe even lowering them. The equity market, which is sending a somewhat different signal in that valuations are still quite high. And so the stock and the bond market are not quite in sync in this respect. One of them will be more right than the other. We'll have to see. But when I mentioned earlier challenging times ahead, the bond market shape of the yield curve is saying there's some challenging economic times ahead, but they haven't shown up yet, because if you look at the left panel, the above part, what you'll see are things like unemployment rate at 3.5%. You know, manufacturing is shrinking, but many of the other indicators of economic health are actually not terrible at this point at all. Now, having said that, let's turn to page 12. And I want to make a couple comments here about inflation. We'd like to put a special chart in each time to try to raise our own game in thinking about the environment that we're advising clients in. So the top chart is essentially inflation. But when you see that green line going across, that's not the 0 line. That's 5%. Okay, we put it in there for a reason, because it accentuates the periods where inflation was extreme. Now, there are 3 such periods in this market period. One is not particularly relevant, and that is the period 1940 to 1949. And the reason it's not relevant is that was World War II. I'm old enough to remember that. Well, actually, not really, but but we were under rationing. There were price controls. There were shortages. It doesn't carry much of a message to us as institutional investors if we're not actually in a period of World War. Then we get the 70s, and two things about that are interesting. One is inflation did spike quite high, and there were actually two spikes. The first spike was driven by, in large part, but not entirely, by what was happening in the oil market. You may recall that was the creation of OPEC. And then inflation started to subside, except that those higher prices got sucked into the rest of the economy, into the labor market, into other commodities, into production costs. And guess what? We had a bigger spike. This is why there is a group of folks that say, we're not out of the woods yet on inflation. If we look at the 70s, the issue now is not how high will inflation go, but how long it will persist and whether or not it has seeped more deeply into the economy generally. So that brings us to the far right-hand side, and you can see that we have a spike, not quite as bad as we saw in the 70s, but relative to 1% inflation, it's a big uptick. It's a very big uptick. And one of the things that you will notice about the 70s experience that may be a lesson for us is in the 70s, when inflation is that high, it erodes the value of other investments because their future cash flows become less valuable. I mean, the longer you have to wait to get your cash flow, the more inflation erodes them. And so and equity has the longest duration of pretty much anything in the market. And so what you see is that PEs in the 70s weren't at their 16, 18, 20, 22, 28, 32 kinds of range that we see now. They were 6, 8, 10, 12, vastly lower than what we see now. So this is something that we're keeping a close eye on. There's not much you can do about it because you need those growth assets in your portfolio. And you will see a chart that I point out many times that you have, by diversifying carefully, you have controlled to a significant extent your direct exposure to what we call equity beta, that is to the fluctuations in value in the stock market. Now, the lower panel is a little bit of a geeky panel. A lot of people think that there's just one inflation measure, right? It's the national CPI, CPI-U. There's actually more than 20 different measures of inflation. And I could go into all the geeky reasons why they're different, but we've plotted one of the different ones here. It's done by, I can't remember which, I guess the Fed Bank of Cleveland does it, their staff, and it's called sticky inflation. Sticky inflation is the worst because it's the kind that is the hardest to bring down. By definition, it looks back in time and says, what prices in the economy were the hardest to pull down, were the last to go down, were and persisted above the inflation rate overall for the longest period of time. And there's good news and bad news here. The bad news is that sticky inflation is also well above 5%. The good news is that at least it has trended a little bit below headline inflation. But sticky inflation is the one that we happen to be watching most closely on this issue of how long might inflation last. And what's interesting is you can still have prices go up even if there's a recession. If inflation expectations have been embedded in corporate pricing decisions, in labor market negotiations, and all other types of things. So I thought that might be an interesting, we thought that might be an interesting backdrop for you.
Just a quick question. What's
Sure.
an example of those in the sticky CPI category that seem to take the longest to get back?
Inflation is a big, or wages are a big one. The wages on a nominal basis are rarely reduced. And particularly overall, it's not like lettuce or eggs where they can, or gasoline where they can soar or they can collapse. Wages, once they move from going up 2.5% a year to 3.5% a year, getting them back to 2.5% is a real challenge. So that's probably one of the prime examples. But housing is, rents are particularly another one because it takes so long to create new supply. You had a great discussion yesterday, and you're going to contribute to the supply for multifamily housing, and the economy thanks you for it.
Dear large things.
Glad we can be useful.
Was that sufficient answer?
Yes, thank you.
So let's, we rarely talk about the chart on page 17, but after a period of time where the stock market has been so good, we often hear constituencies criticizing our clients, which are boards like yourself. Well, why didn't we put all our money in X, Y, or Z? The last thing that really did well. And the chart, the quilt, what we call the quilt chart, just drives home with a sledgehammer that unless folks like that are prepared to guess accurately what the next year's best asset class will be, and the year after that, and the year after that, quite frankly, nobody has been able to do that. There is no investment product out there. There is no pundit. There's no one who's been able to do this on a consistent basis. So when you hear from Monday morning quarterbacks, though, why don't we put all our money in X? Just do what I didn't exactly say I would do to central bankers who say we need more inflation. The only thing I'm going to say about page, I'm now going to move to the quarterly investment performance analysis, the bigger book, if that's okay. Chair, do I still have 10, 15 minutes?
It depends on how much John wants to present in his report.
Technically, you're out of time, but.
Okay, well then I will hurry. Then page 2, I will just say thank you, and we're very proud of our people. Let's see. There probably is a point or two that I want to make here. Let's end up on page 13 because I think it's a great page, and you know from past experience with me, it's one of my favorite pages. So we'll look at page 12 first. Page 13 is the same page as 12, but over a longer time period. One of the things that you're always trying to do is to squeeze as much return out of the risk that you're taking as possible. Now, there's many ways to measure risk. One of them, though, is volatility. And volatility does matter, particularly if you're a mature pension plan, because ups and downs are not good because you still have to pay benefits when values are down. So for some types of funds, volatility is not the most important metric, but for pension plans, it's definitely one to keep an eye on. The upper left-hand on page 12, the upper left-hand panel is a chart. These are all pension plans. They're all legitimate comparables to you in terms of size and so on, and they're all public pension plans. And plotted here is over 5 years, how much risk your benchmark showed, we track it for you, and how much return it had. And then also how much your actual portfolio, how much risk it showed in terms of ups and downs, how volatile it was. Kind of like my eldest sister, but we won't go into that. And the return that it showed. This is really a good chart because what it says, your actual portfolio is the green diamond. And because the crosshairs are the median risk and the median return. The median risk is the vertical one. The median return is the horizontal one, where half lies above and half lie below. You are above. Congratulations. But better yet, you're above, but you're far to the left of where the volatility that has been exhibited by the benchmarks that make up your policy portfolio. So what that means is that you're squeezing more return out of the volatility risk that's actually taking place in your strategy than one might expect. So where does this, where do we geeks in our profession validate this? We go down on page and we look at the left two statistics. Standard deviation is a measure of volatility, and your benchmark is at 51, but your risk is much, I should say, your median in terms of the risk that you're taking. Wait a minute now here. Whoa. Okay. Your return of 1325 is really excellent versus the risk that you took. And similarly, that shows up when you compare your what's called a Sharpe ratio. And that is, it's a measure of asking the question, okay, we had good returns, but if we compare that to how much risk we took, how much of this excess return, how does it relate to the amount of risk that was exhibited in the benchmark portfolio? And you were very high. You can see that 98. You had a benchmark that was one of the most volatile, and yet your return was in the top quartile. That means that you were squeezing a lot of return out of the risk that wasn't predicted. It was actual risk that your strategy would have done if your strategy would have been executed just as it was written with indices. And by the way, in the interest of time, I'll say that over 10 years, the same consequence is true, the same outcome is true. So with that,
From a layman's perspective, is it fair to say then that PERS is investments are pretty sound?
yeah, it means that your diversification and your management of the portfolio, tip of the hat to John's crew, has been very prudent, very prudent. Last, I promised a Jack Prothero memorial page. It's page 17, and it's things that to worry about, because you can't have Jack go back to his cabin without things to worry about. So let's go down the list. What do we worry about in domestic equity? We worry about valuation. It is still high relative to historical norms, even though it's down from a year ago, which caused us to raise our long-term forward expectations, but valuation is still high. We're not wildly enthusiastic about it. It's just better than it was. Core fixed income, that in those inflation charts that we talked about. If inflation trends up even moderately or persists longer than the market expects, and the market doesn't expect it to persist all that much longer, core fixed income could have another downtick. Non-core fixed income, same issues, but in addition, we have had a situation which I referenced earlier, and John and I were talking about it, and that very, very low, almost zero interest rates caused a lot of companies that maybe should have gone bankrupt, but didn't have to because they could always get access to new money over the last 10 years. Default rates have been very low. They could go up again if there's a recession. So in the non-core fixed income area, we worry about inflation simply because they are bonds. But in that area, we also worry about default rates. Real assets, I think the issue there is that we worry about the structure of your real estate investments because they can't be changed easily. But your staff has just done a terrific job there. Same thing with real estate. One of the challenges here too is that you don't see it in the background, but a lot of the reason that interest or that property values are falling is that the loans that support them are now having to be rolled over at much higher rates. And so debt rollover and back to the office and adjustments to your pacing are the challenges that you face there. Private investments, you may have a challenge to maintain vintage year diversification like we talked about yesterday. If there's a downturn in the market, the public markets go down, your private equity share of the portfolio goes up simply because it moves slower in terms of its valuation. And you may be tempted to, as we talked about yesterday, to overly squeeze your pacing and maybe miss some vintage years. That's going to be a tough call. It's not an easy call. So Jack, those are the things that we worry about and we encourage you to worry about.
Well, thank you very much. I
That
think
also-
that's a little more than normal.
Well,
Just one final, any questions for Jim? Well, that was a good overview. Why don't we take just about a 10-minute break and then we'll give John time to get ready for his presentation.
The piece where I wanted to make sure we have some time.
Good.
So you guys can ask questions.
Okay, welcome back to the meeting. We'll get started. We're on tab 8, investment update. Start off with John, and then we have a lot of other presenters, so feel free to get started, John.
All right, thanks, Mr. Chairman. I am starting on slide 4, as you said, behind tab 8, CIO update, the economic environment. I won't spend a lot of time here. Jim covered it well. But would agree with him that, you know, most of the signals are kind of generally pointing down towards lower growth or potentially a recession. You know, I think the one call out for me anyways here is kind of maybe 2, I guess, is job growth has maintained pretty good levels. In fact, post putting this slide together, the April job numbers were 253,000 added, and in any other business cycle, that would be a pretty decent number that we'd be excited about. Now, that's lower than we've kind of been trending prior, coming out of the COVID environment, but nonetheless, still pretty solid and certainly very low unemployment rate. And in addition to that, as Jim mentioned, you know, CPI, inflation in general remaining relatively high and a little bit sticky, although it's come down significantly. It's still nowhere near what the Fed wants to see at 2%. Moving to slide 5, you know, just wanted to provide a slide here that shows how sharply the Fed has increased rates here. It has been extremely significant, which has caused a repricing of the value of really all assets. And I would also point out that this isn't just the Fed, this is a global central bank process. You know, most global central banks are also raising rates pretty substantially. And you can see the effects for a few things that I called out here. Cryptocurrency world sort of falling apart, seeing some cracks in the overall financial system, culminating, of course, with Silicon Valley here, but then, as I'm sure you've all read about, Silicon Valley, then Signature Bank, Credit Suisse, First Republic. So the withdrawal of all the easy money that we've seen over the last decade plus is definitely having an effect. But I think it's also notable that I don't think the Fed is afraid of breaking some eggs here. Probably knew they were going to break some eggs, and I suspect there are probably, you know, more things to come. I don't mean to say by any means that I think this is 2008 and there's some collapse in the financial system or something, but when you raise rates and you reprice assets like has happened here recently, you know, the people who were sort of out on a limb, they're suddenly exposed, and I think that's somewhat what we're seeing happen. Turning to slide 6, I think one of the other pieces that's going to
Why don't you join the board?
is tighter bank credit standards. So clearly the stress in the banking system and the removal of easy money and higher rates has caused banks to start to pull back in terms of their ability or willingness to lend. And this chart actually only goes through the January survey. So this is the senior loan officer survey of banks that the Fed does regularly. We got the data through April, the April survey, and a little after I put this together, and it shows a little bit more of an uptick in their unwillingness to provide credit. And I think some of the areas that have been in the news and things, and as Jim talked about, real estate would be one. Certainly, you can see that red line there is commercial real estate lending standards have tightened the most. And I saw a slide from one of our managers that I was at one of their annual meetings recently. He put up a slide that showed that 80% of the lending to commercial real estate comes from small and medium-sized banks. So, you know, you think about that, there's going to be some ripple effects there over time. and concerns about asset liability mismatches in addition to, kind of what are the value of those assets that are on some of those bank balance sheets. Moving to slide 7, I'm sure you've also seen in the news the information on the debt ceiling and politicians' lack of ability so thus far to come to an agreement. And just wanted to show, this was actually a slide that goes through April of 27 is when this was a snapshot here, and the differential between kind of the very short-term T-bill rates and, T-bill rates post the debt ceiling if they don't come to an agreement. You can see the huge gap. If we're looking at it here, just as of today, the T-bill that matures on May 30th was sub 3% yield this morning. The T-bill that matures on June 1st was 6.5%. I think Kirsten and John's team, they bought one yesterday for 6.5 or something that was yielding like 7%. So, I mean, that's just obvious huge dislocation there. So something to keep an eye on for sure. Questions about any of that before I move on? All right, seeing none. Slide 8, 9, and 10, kind of assets under management by asset class, participant type, and pool. No real significant change here. Obviously, we show this to you each quarter, but happy to answer any questions if there are any. All right, seeing none. Pension asset allocation on slide 11. We are well within all of our policy ranges. We've been a little underweight to most of the public market asset classes for the last couple of quarters here. A lot of that's just kind of driven by the denominator effect, as we've seen declines in the public asset classes in a lot of areas versus a lot of the private illiquid stuff holding up a little bit more so, at least in terms of the mark. We have been trying to keep cash a little bit higher as we are getting a yield there, as Jim pointed out earlier, and so there's also been a lot of volatility in the market, so I think that's been prudent to keep a little bit of dry powder around. And we've been tapping public equities, mostly domestics, when we see kind of the bounces that happen periodically in the market, and a lot of that has been, as Jim pointed out, also the valuation difference between domestic and international. So on a relative basis, international looks a lot cheaper. So we've kind of kept that closer to the midpoint and been a little more underweight, probably domestic, but really at the margins. Slide 12, just another look at asset allocation, just in terms of the overall dollar values, but as always, well diversified, no major change overall positioning that we've got in the portfolio. Questions about any of that? All right, so pension net performance. You can see the 1 year, of course, a slight decline in the overall performance number there, in addition to the net cash outflows that of course happen every month. More importantly, I think over the 5 and the 10 year time frames, you can see that the amount that we've been able to earn on the assets under management has substantially exceeded what we needed to pay out in the overall benefits. And obviously at the end of the day, we need to be able to pay benefits, and we're still able to grow the size of the portfolio. So that's all good. Slide 14, just the numbers here for pension net performance. No real surprise here, I don't think either. It's reasonably consistent, and most importantly, I always like to point people towards the longer time frames and see that over 10 years, 20 years since inception, we are broadly meeting our actuarial hurdle, which is of course what we're here to do in the pension portfolios. The executive director was noting to me that we should put fiscal year to date in here, since we're state government and apparently we only care about fiscal year to date most of the time. But fiscal year to date numbers through yesterday were up 5.23%.
John, these numbers are nominal, right? They're not including inflation. Are they net of inflation?
They're not net of inflation, no. Slide 15, AUM outside of cap or pension. So all the other clients that we have. Again, no real relative change here in terms of who the biggest or the smallest ones are overall, but I'd like to show that to you each quarter as well. Questions about anything there? All right, looking at slide 16, talk a little bit about the short-term investment pool. So at the end of the quarter, our weighted average maturity in the portfolio was 62 days. That has come down substantially. It's about 43 days now, so shortened it up quite a bit. A couple of reasons, tax rebates and things that are going out the door that we know pretty soon here, given some of the things that were passed in the legislature. So there should be some outflows from the general fund accounts. And then maybe more significantly, even as I mentioned, higher yields on the front end. So you're really not getting paid to go out, 60, 90, 180 days, getting such high yields in the front end of the curve. That's been something where we've shortened up a little bit. Slide 17, STIP performance. Current STIP yield, I didn't actually look this morning, but it's getting close to 5%. I think it's just shy of 5%, 4.9, I think is about where we're at. So a nice benefit for all the STIP participants who have been getting, close to zero for a lot of years. So that's a big change. Fiscal year to date here for STIP is up 3.24%. Any questions on STIP? All right, moving to trust fund on slide 18. Again, well within policy across all of the asset class ranges here. Overall net performance down a little bit for the year. Fiscal year to date, we're down about 2.1%. But I think the more important number here as we look at, I'm on slide 19, looking at the bottom one there that says yield trust fund investment pool. That's essentially what, so most trust fund participants, they care about the income, right? They don't really care that the value of their assets go up or down because they can't spend the principal. They care about what's the income stream that we're getting off of that. And so that has been more steady over the years, but had been trending down. Now it's starting to trend back up a little bit. You can see at the bottom, the 3-year number, kind of back up in line with what the 10-year average has been, and probably goes a bit higher over time.
I got to ask a question on this. So John, in the trust fund investment pool in the real estate, the 26%, that's primarily the buildings that we own?
No,
That's other besides that?
yeah, that's primarily similar investments to what we do in CAP, although we stick more into the core plus realm there because trust fund cares about the income distribution. So there is a small piece of that in there, Mark. I don't know how big the trust fund buildings are in terms of our overall.
Less than 26 billion, or 26 million.
So like less than 1% of that is this building and the other buildings we own.
Does the trust fund investment pool, does that include the Coltex trust?
Some of it, yes. Yes. Slide 20, state fund. So again, within policy limits here, you'll remember last quarter when we were talking about state fund in February, we were slightly out of policy, just above the limit in real estate. We got some redemptions back there, and then just a little bit of repricing has brought us back down under the top end of the range in real estate. Would expect that to continue to come down. We'd probably like to see it ultimately more like 6%. Hopefully it comes back to us more in terms of redemptions than it does a repricing of the assets, but I suspect it will be a little of both. We still have pretty significant redemptions in place there for several of our managers. You'll also remember we added real assets as an approved asset class to state fund last quarter, but we don't have any exposures there yet. So once we do, we will add that into the mix. John Ramasco and I, and actually John Carpenter too, met with their staff last Tuesday. That all went well, just kind of the regular quarterly update, and we are meeting with their Finance and Audit Committee 2 weeks from today on June 8th. So we'll go give their board an update as well.
I think there was some issues with them over.
Yeah.
With what we were doing and whose responsibility was whose. Has that basically been settled? Do you feel comfortable with that?
I think it has. I feel like we're on a much better track at this point, and I think we're in a good space. So we're back again once we talk to their Finance and Audit Committee in a couple of weeks, but yeah, it feels like we're in a good spot there at this point.
They've made some structural changes over there. Or reassignments.
Okay. We'll go in detail offline.
Slide 21, state fund performance. Again, I would just, well, good performance across the board, similar to what we've seen in the other portfolios here. Fiscal year to date, up about 1.28%. Remember that as well in February, we changed the fixed income piece to the aggregate benchmark rather than the intermediate ag. So we made that change as of April 1st with our custodian. It's easier for us to change on kind of the quarter to make that change. We were out of policy, so the policy says we have to be plus or minus 20% of the benchmark duration. And just by virtue of the change in benchmarks, we were immediately out of policy when we changed that benchmark. But at this point, we are inside a policy, not by a lot, but we're up to about 82% in duration, I think, for relative to the benchmark, and continuing to do that as we talked about when we made that change. You know, as we get maturities and are able to get cash in and roll securities over, you know, we'll keep extending that benchmark and get it closer to what the benchmark is over time. And it's been a good time to do it. I mean, we did well by having a short benchmark, relative duration, kind of going into this environment, and now we're seeing higher rates, so it's a good time to sort of take advantage of the higher rates and lock that in. Questions on state fund? All right, slide 22. We've talked about it here a lot. So, you know, higher rates, tighter credit conditions, lower earnings, debt ceiling, geopolitical stuff, a lot of things going on out there. Kind of a cautious outlook on our part, or at least on mine, I would say. We're not being penalized for holding a little bit more cash, so trying to keep that a bit higher. I think I mentioned it yesterday. That's been a little bit of a challenge because on the illiquid private side, real estate, real assets, we've had a lot of managers that see opportunities because other people are pulling back, so they're calling capital and looking to take advantage of that, which is good, what they should be doing. But you know, that creates some cash needs, and so I always have to figure out how to kind of balance that equation, but has not been a problem so far, so good. On the public market side, we made our initial funding of $50 million to our convertible bond manager, and Jason will talk a little bit more about that later. I think he mentioned last meeting that we had that he and Steve did a great job of renegotiating a lot of our fees with our international managers, resulting in more than a couple $1 million in annual savings for costs there. So that's great. Working on some improvements to our due diligence legal negotiation process. I mean, it's kind of a constant, but I wanted to call it out. Ethan had set up a meeting with DLA, our outside legal counsel for all of our private investment type stuff. And they came here and we had a great conversation in a few areas where we thought there were some improvements that we could make to our DDQ process and kind of make sure that they're not doing some things or giving us a reasonable deal and not, you know, I don't know, they're always pushing for more on their side, and we have to push back in a lot of areas. So that it was a real good conversation, and we kind of vowed to continue that on a hopefully annual basis with them, because I think DLA provides a lot of value in that realm, because they see, deals from all kinds of people, and so they've got a real good feel for the market in that sense. Few additional separate accounts that our executive director talked about yesterday that we'll be addressing in a special board meeting at some point here. You met Willie. Matt Hoffman, one of our operations analysts. He's been with us a little over a year now. We promoted him to level 2. He's been doing a great job. He's kind of the Solovis guru, I guess, if you will, at this point, whether he wants to be or not. So he's doing a really good job with that. And as we talked about, our intern will be here starting next Tuesday, so.
You hired Bill Gross. I'm impressed.
Yeah. He doesn't even know who that is. He's too young. Any other questions for me?
Thank you, John.
Turn it over to Aaron.
Good morning. One thing I might just kind of touch on before I start is this attribution is one that we put together in-house. And recently, it's kind of been a project for Solovis and getting them to the point where they can help us put this together using their system. So we are to that point. So what I'm going to use that for is basically a check on this on a quarterly basis. I don't think the output is quite as friendly as this. And it's not even that friendly as is, but just a reminder that we're kind of really working on getting Solovis as useful as we can, and it acts as a good check for this. So jumping right in, not many of these points have changed much since last quarter, but had we been invested at our benchmarks, at the midpoint weight, we would have returned approximately a negative 4.4% return. Real estate and cash were the only positive contributors there. In tactical asset allocation, the aggregate overweighting, underweighting of the asset classes relative to their benchmark increased the portfolio's return by a modest 14 basis points. Again, this is just to show you that we're not making any sort of bets one way or the other. Whenever we're getting just a little bit away from a midpoint, John will have us rebalance back. Style selection, both these points have been on here for a few quarters now. Let me know if there's any questions, but I guess the biggest takeaway is there's not a lot of style bets that we're making anywhere. Within manager selection, international equity had some managers that slightly outperformed and some that slightly underperformed. Not a lot to add to the overall pension return. It's the same story with non-core fixed income. Within core fixed income, our internal portfolio did add 7 basis points to the overall pension return. Private investments, again, this is kind of the same story as last quarter. It added a lot of effects. Of course, a large percentage of this could be attributed to its benchmark being a public equity benchmark, and the private investments being valued much later. Within real assets, both infrastructure and commodities had some pretty large contributions this quarter or this year. Of course, commodities being our equity portfolio and timber. And lastly, within private real estate and the REIT manager both added a total of 48 basis points, with both of them contributing quite a bit. That's all I have, if there's no questions. Thank you.
Hi, Mr. Chairman, members of the board. I'll be starting on page 26 with domestic equities. And you look there at the one-year returns, obviously down, but there's a lot that's happened over the last year, the last 15 months. a period of rising rates in 2022, which was just a bad environment for just about everything, stocks, bonds. And but as we got into the fall, there were some signs of inflation cooling, and markets started to anticipate being closer to the end of the Fed's interest rate hiking cycle, and hit an inflection point. So we've generally been on an uptrend since last fall. Equity markets seem generally to shrug off the banking crisis and rebounded from that in March. But really the story this year has been, as Jim noted, the rally has not been a broad-based one so far this year. It's been really concentrated in a handful of mega cap growth stocks. And that has driven the bulk of gains year to date. And it's quite a shift from the value-led markets that we saw starting back towards the end of 2021. Performance of the last year for the different plans were roughly in line with the respective benchmarks, and as we'd expected. I'm going to move relatively briskly, but I don't want to do that for you to feel rushed. I want to spend more time, leave questions, time for questions, as opposed to just hear me describe things that you can see on the page.
We're not a shy group, so we will interrupt you if we need to.
Page 27 shows the characteristics. Again, being all indexed investments very close to the benchmark in terms of sector weights, modest overweight to small caps. And I want to clarify too, one thing is like, okay, so we talk about being all indexed, being all passive in domestic equities, but we have the ability to adjust our allocation between large cap and small cap. So that is an active decision. So the overweight to small caps is an active decision, but the investments within the domestic equity portfolio are all indexed, tracking an index. Page 28 shows the trend of PE ratios. Obviously, quite a precipitous drop starting last year. A bit of a rebound more recently. The forward PE right now in the S&P 500 is right at 18 times. That compares to the longer term average of about 16.7 times. So a little overvalued relative to, say, a 20-25 year history.
Jason, do you have a target PE ratio that you?
No. Any questions on domestic equities? Move to page 29. International equities continue their outperformance in the first quarter of this year that started last fall. Largely has come from developed markets, as developed markets have outperformed both international emerging markets and US stocks. But we've seen some of the same dynamics in international equities as we saw in the US, with large caps outperforming small caps and growth over value. The small, in terms of the last year, the small cap overweight was a bit of a drag on cap, but active manager performance, which I would characterize as mixed, was generally a positive for over the last year. Page 30 shows the characteristics, no real change in positioning in the quarter. A slight underweight to emerging markets, which I'll remind you is not a conscious decision on our part. That is an outcome of the decisions of our individual active managers. We have a modest overweight to small caps, slightly more active than passive. If you remember back in the asset class review in April, we talked about increasing our exposure to active, and that should, at least initial stages of that, begin soon. One other note on passive, we talked about ETFs, the use of ETFs in the portfolio, and the way we described it at the asset class review, and we use ETFs in both the domestic portfolio and international equities as a basket of stocks that track an index, and together they trade like a stock on an exchange. That's true for the ETFs we use. They're all tracking an index. That is not true for all ETFs. There are all sorts of types of ETFs. There are actively managed ETFs, but for our purposes, the ETFs we use are tracking a specific index, and so we consider them to be a passive investment. Page 31, same story with valuations dropping what we saw in over the year with rising interest rates in 2022, a little bit rebound recently. But international equities trade at about currently about a 30% discount to US equities, which 20-year average is closer to about 15%. So that gives you an idea of
What percent?
it's like 28, almost 30% a discount to US equities.
Right now, but historically it's.
Like the 20-year average is about 15%, so it's like twice as cheap. Any questions about international equities?
Is there an approach, I mean, obviously with domestic, we're entirely passive. Is there, a strategic reason for remaining active in international versus just all passive as well?
Yeah, I think so generally speaking, we talked about this when I came on the team and two when my predecessor left, it's like, what do we believe? We believe that the US market, equity market are the most efficient markets in the world. Shouldn't our portfolio reflect that? And that's the reason, a big reason. Why
You might explain what efficient means.
hard to beat the index. Very difficult, not impossible, but very difficult to beat the index and beat it consistently using skill.
Means that the prices affect pretty much everything that is available that can be known, is embedded in the price.
Now, with respect to international equity, I have a little bit different view that some of it is the data we see, some of it is our conversation with managers, that it's less efficient, that certain stocks that they invest in have no coverage from sell-side research that they can find, and there are a lot more securities too, a lot more stocks to pick from outside the US, and that there are more opportunities and great opportunities for outperformance, the ability to beat a benchmark would be in the US. And so those beliefs reflected in the portfolio.
If you get a chance to join us when the trustees come out or at here in Helena, we'd be happy to walk through the active passive study that we execute every single year with new updated data, which shows that the probability, no guarantees, but the probability of active management actually producing some excess return are higher in some areas than in others. They're very low in large cap US equity because it's efficient. Information about these companies is everywhere and well known. Less true in international stocks, even less true in emerging market stocks.
Yeah, one of the things too, and this is one thing we discussed when we were considering going all passive domestic was what about small caps? Are small caps less efficient in the US? That maybe to be indexed the large cap portion. You look at the trends, and it was interesting because my colleague Steve Strong had data that shows comparing the median manager performance going back to the 80s in small cap, massive outperformance over small cap benchmarks. And that just kept eroding away in time. So much, much less recently than it was 30, 40 years ago.
That erosion was was caused by the easier access and more regimented or more dependable access to information about these small cap companies, in the same way that the large cap companies are now very well known.
Yeah, that makes sense. Thank you.
Moving to page 32, non-core fixed income. High yield bonds, had solid returns for the first quarter after having a down 2022. Again, the story of last year we talked about many times of rising interest rates. You would think in a massive sell-off that high yield would be punished more than investment grade. Was not the case, largely due to the fact that high yield bonds have less interest rate risk, they have shorter duration, and so that was a little bit counterintuitive for last year, but a little bit of a rebound here year to date in high yield bonds. Emerging market debt was up in the first quarter, but lagged US high yield. Preferred securities, which, as we talked about, have a large exposure to banks and financials didn't fare so well with the turmoil in the banking sector in March. In terms of active management, high yield active management has added value over the last year, largely due to a more conservative approach by managers. Again, as Jim was talking about, that hasn't been the case all the time. But back prior to COVID, everything was up to the right, and being conservative would leave you behind the benchmark. But at least more recently, there's been at least more dispersion among credits within the high yield universe, and more opportunities to add value. The active management preferreds was a more significant detractor over the last year. Emerging market debt manager underperformed by much less than the preferreds manager. Again, we added convertibles in March. That's off to a good start. Page 33 shows the characteristics. If anybody has any questions there, I'll just summarize. There's some really big differences between our exposure and the index. The index, the asset class index, is the high yield index. And so when we add preferreds, when we add emerging market debt, that makes things look different. And we're fine with that. We're accepting, that type of risk. We want exposure to certain types of issuers, we want some diversification. And so it's not as if we're trying to track the benchmark in non-core fixed income. But if you look at so preferreds, about half the universe is investment grade, and emerging market debt, about 60% is investment grade. So that gives you an idea of why those credit rating exposures might be so different from the asset class benchmark. And two, with respect to sectors, again, prefers is like 60% banks. You're going to see that reflected in the sector exposures. Page 34, you see the trend of high yield bond spreads. So the spread for high yield bond really is just the extra yield that you get from investing in a high yield bond over US Treasuries. And spreads have bounced around a little bit this year, dropping below 400 for a little bit, getting above 500 basis points for a little bit. Now currently around 460-ish, which is kind of an average level, which usually you don't get to be at the average level because you have very high highs and very low lows. But it's within a range, a normal range of the last 30 years. Certainly would not be considered at distress or stressed levels. I think one of our managers says, you're fairly compensated for the risk. We talked a little bit too about expectations for default rates rising this year. Obviously, these are projections. The estimate would be maybe to get back. We've had very little defaults in the last year and a half or so. In some periods, like zero, which obviously that's not going to persist. But maybe we get back to a level this year that's closer to kind of long-term average between 3 and 4% default rate. Page 35, we discussed at the February board meeting the addition of Zazov, which we funded in March. And contrary to some of the other strategies we've been in, our timing this time was, I think, really good for a couple reasons. First would be we funded the account right around the time of when all the information was coming out around Silicon Valley Bank and the banking crisis. So we got some things. There's some bargains to be had a little bit. Our manager was deliberate in putting the money to work, which I think was prudent. But by the end of the quarter, by the end of March, the portfolio was fully invested. Also, too, in terms of the timing, there have been some issuers in sectors that typically aren't real active in the convertible bond universe. Convertible bonds typically very high in tech and healthcare, but we've seen issuance more recently, like from utilities, and that's atypical. And other atypical issuers that issue in the convertible bond market that, at least according to our manager, said in terms of building a portfolio to obtain diversification by sector, this is as good a time as any you've seen in the past 30 years. So, which I thought was good news. That's it. Any questions about non-core fixed income?
Thank you.
Mr. Chairman, members of the board, I'm on page 36, and we'll be covering off real estate and real assets over the next few minutes. Page 36 represents our real estate exposure as a whole between state fund, trust fund, and CAP, the pension fund. I'll note that the values are missing. I'll make sure that that doesn't happen going forward, but quick FYI, that represents 2.5 billion of net asset value, 1.6 billion in pension, 766 million in trust fund, and 112 million in state fund. We also have performance here and a few bullet points. You know, I hate to be an echo chamber here, but transaction volumes are essentially way down in real estate as interest rates have skyrocketed. Debt has become non-existent, scarce perhaps, and only the best deals. Prices are adjusting slowly, rapidly. It sort of depends on the market, the asset class, the property type. I expect that will continue throughout the course of this year, and we'll continue to see markdowns in the portfolio. As we have finally entered into the back end of what has been a prolonged real estate upcycle. Happy to answer any questions.
The, on page 37, the office exposure.
Yeah.
Is there any notable issues with that or expectations of issues with performance or value?
Yeah, for sure. I expect there to be notable issues and notable value declines. Most of that office exposure is in our core funds, which we began selling out of probably 2 years ago. I desperately tried to get us out of our core funds entirely. We are now stuck in these open-ended core funds that have massive multi-billion-dollar redemption queues. So much to my chagrin, we are going to be the unfortunate beneficiaries of extreme, what I think will be, permanent impairment in the office sector on the order of 20 to 40%, maybe even greater, depending on if our managers can find different uses for this office that exists. Most of this stuff is in the core funds in CBDs, central business districts, which, theoretically are places people want to be. But that return to office, despite everyone's best efforts and all these headlines you see, is only at 50% right now nationwide. And folks may find different uses for office, multifamily. San Francisco has been in the headlines recently with passing a bunch of legislation to try and incentivize different uses, et cetera. You've heard of things as far-fetched as battery farms, but floor plates and tension and tensile strengths likely will not be supportive of that unless it's the bottom floor. But yeah, it's going to be a bloodbath, in my opinion, in office for sure. No doubt about it. There is a paradigm shift that has occurred, and we're not going back, and there will be permanent impairment, no doubt, unless you are highly differentiated with your amenity base, highly flexible with how you respond to your workforce needs, and you keep your footprint versus reducing it. Yeah, I'm concerned, no doubt.
So when you say a bloodbath, how much blood are we gonna see here?
Yeah, like I said, permanent impairment, in my opinion, of 20 to 50%. And how that translates into value in our portfolio, I could do that math maybe at the off the top of my head, but I could do a more deliberate exercise and get you a different number. But still, it's going to be a guess, and I could be grossly overstating my concerns. But yeah, you know, I'm not a big fan of our core fund exposure. I haven't been for a long time. I've been trying to get us out and we've been lagging out. You know, core fund exposure had a double-digit decade-long run post GFC. And that's just not what core funds are designed to do and haven't done historically. And so I saw a giant reversion to the mean come in even before the pandemic. And now we're stuck in these funds.
What kind of timing on your bloodbath? You got a number of how bad the blood?
It'll play out. So I don't think it's gonna be a cliff. I think it's gonna bleed out over the next probably 2 to 5 years. It probably won't go 5 years. People would be wise to take their lump sooner than later and sort of move on, but you know, the whole industry is sort of doing one of these on what's going to happen in office. And so the numbers I've given you are representative of sort of both ends of the spectrum. So I'm just trying to be as uber transparent with you all as I possibly can.
And Ethan, what's the percentage of the real estate portfolio is blocked up in queues?
About 20%.
So that's actually not a big number. I mean, in all things considered.
I respectfully disagree.
It could be much higher, let's put it that way.
20% of that is
What
locked
was it
up
at
and
as its peak?
34% of that is in office. So yeah, I mean, that's material in my perspective.
Oh, it's definitely material, but what was in core funds at the peak of the program?
38% maybe.
So the point I'm making here is that your staff has worked this down from 38 to 20%, which while it's still material and it's a risk, you know, I think the board should take comfort that your staff is not asleep at the switch here in the slightest.
I would also note that, I don't know what the numbers are off the top of my head, but I know we're underweight office relative to our NCREIF benchmark.
True.
Purposely.
True.
For what Ethan just said, but.
Thanks for that, Jim.
So while it isn't,
It's just true.
it's not great, it's not as bad as it could have been if you hadn't done, you know, that down.
That is an accurate statement, without a doubt.
Okay, we're gonna be glass half full here.
Okay. I love it. I love
What's
it.
in the glass?
Yes.
It's not explosive, okay, it's just water.
Yes, ma'am.
But I guess back to the empty half of the glass. Could you get us some numbers? I mean, could you show like, here's the worst case scenario,
Sure.
here's what our expectations are,
Yeah.
and get some.
Yeah, absolutely. No problem. Thanks for skipping ahead. Are there any other questions on page 37? I'd just note that, you know, everything's within policy constraints. What's not listed here is leverage, and maybe we talk about that or get it here eventually, but we're well within our leverage constraints as defined in our investment policy statement. Moving to page 38, you know, real estate valuation. This is a snapshot of what Green Street, which is probably the preeminent commercial real estate research provider on the street. This is right out of one of their reports. Again, very representative of what you've heard from Jim and John and me, but a nice visual representation across various property types to show you the repricing that's going on in the market. Any questions?
Maybe one thing I would point out, just for the glass half full side of the equation. In most instances, Jim pointed out earlier, and probably office being a little bit of a separate entity to a degree, you still have cash flows coming off of these investments, right? So that doesn't cure everything, but in the instance of, you know, it's very different than, say, the industrial properties versus office, right? Because industrial, yeah, maybe the value of the property went down a bit because interest rates went up, and so your capital costs are higher, but rent growth is just like, you know, same for some of our database or, digital infrastructure type stuff that Ethan was talking about yesterday. Office, not the same dynamic by any means, but there are still rents there that are also coming in and, over time, similar to bonds, that lease payment, rent payment, helps cure some of your bills over a longer period of time.
So this chart on 38 echoes what I said earlier, and is that this is not a real estate problem. This is a problem with some sectors of real estate that happen to historically have been very big. Other parts of real estate have been booming. And, Ethan's a better judge than I am as to whether or not their prospects still look fine. The second thing is that, even in the case of offices, they're not homogeneous. Offices in troubled downtown core business, and we all know about the troubles that are occurring in a number of US cities in the center city. I would call that a special category, because it's one thing to downsize your footprint in a CBD in a city that is otherwise reasonably healthy. It's another thing to exit that CBD altogether for another jurisdiction. And, again, Ethan will know way more about this at the property level than I'll ever know. But again, when we use the word office, there are categories of risk. There's a risk spectrum in terms of that glass half empty.
So going back to the glass half full and maybe pinging off of what John said, and it's important to note that there is also a lot of chatter in the market about the capital markets, that is the transaction activity and the valuations in real estate being totally disconnected from what's going on at the property level on the ground. And what I mean by that is, while industrial is repriced, depending on the market and the product or the type of the building, anywhere from 5 to 15%, rents are still growing anywhere from 8 to 20%, depending on where you are in the market. There's an industry term called loss to lease, and it's sort of counterintuitive, but in today's day, because industrial rents have climbed so much, when somebody's lease is expiring today and they're renewing, and the probability of renewal is virtually 100% because vacancy in some markets is sub 2% and they have no place to go, they're having to sign new lease contracts at 40% higher than their current lease rate. So there is this dislocation going on, and these cash flows are still coming in, and in many cases, they're still rising. In some cases, they're coming back to sort of historical norms, but they're still growing, and they're still growing, and in some cases, in excess of inflation, at inflation, 3, 4, 5%. So it's not total doomsday scenario by any means, but
Still a bloodbath.
worth sharing. Office in particular. So worth sharing.
In future meetings, don't use the word blood.
I'm a passionate guy and I just want you all to be prepared.
But I think from the board's perspective, we pay benefits not in the asset value, but in the rent payments. I mean, that's the key piece here, is for the purposes of making sure the teacher gets their check at the end of the month. Those rent payments are more valuable to us over the long term than is that office building worth $1 million or $800,000.
But-
Not that that's
It's
immaterial.
at renewal of the lease, if they walk, though,
Yeah.
that's the issue.
Right.
Then the cash flow goes
Yeah,
away.
if it will continue to be leased in 10 years from now.
In which case, I know some cops in Butte. No, wait, I didn't say that.
You're recorded, Dan.
Even when you give us this additional information we've talked about, if you have anything on, I guess, the social aspect of the remote workplace concept continuing, is that something that we're sure is going to continue? Are people going to go back into the office? I mean, I think it seems to me like it still must be in flux, and I don't know, but
Yeah.
I mean, if you got any good, solid information besides the anecdotal stuff that we all hear about.
It's funny. That touches upon what I refer to as the complexion of the human condition.
It's ever changing.
And impossible to predict.
This is what I think about that, and just my opinion more than it is fact, but somewhat anecdotally, but I've seen some research would probably stretch. Management hates it, employees love it.
Yeah.
If the Fed is successful in slowing the economy down, we have a recession and unemployment goes up, management will be in a different position than they are today, where they can't find the employees to fill the positions. And I think it will revert back to more in office. And you've already seen that to a small degree, as you've seen probably more management teams pushing back on that, because they've seen that in some instances, depends on probably what you do, it doesn't work as well if you don't have particularly the younger people in the office learning from the older people.
And just the
I don't-
human
you know.
interaction you get from being in the office.
Absolutely. So I think that may revert a little bit longer term, but we'll see, because there's also some structural things with employment that, maybe will be tight for an extended period of time, because we don't, we have a demographic issue as well.
Well, if you have anything that's more concrete, a mention of that and what you're going to tell us would be helpful.
If I come across something, I'll certainly be happy to share it. But it's anyone's guess how structural this is and if the paradigm's permanently shifted. I mean,
Permanent's a long time.
we've been back in the office for I don't know how long now. I really wasn't ever paying a whole lot of attention to that, but I mean, despite major Fortune 100 company CEOs saying, get back to the office, their workforce is still saying,
No.
no way. So I expect it will be some permanent shift that will settle somewhere, in the 70s, maybe ultimately, but getting back to that where we were, I don't think that's ever going to happen.
Right, but
That's a societal shift that was brought on by a pandemic, and those things happen.
it seems to me that it's still settling out.
I agree with you.
Yeah.
Yeah, it's TBD.
Then
And
just
there are
on the young
companies-
people side,
Yeah,
a lot of the
that's what I
young
was
people
saying.
that I speak to prefer to be in the office because at least the ambitious ones, right? I think that's the key to that, is that if
So
they're
watch out
ambitious
for Rob.
and they actually care about what they're doing, dependent upon the city and the field that they're in. So when I talk to the folks that actually work with the people that we work with, and some of the folks that are in the state of Montana, for example, a lot of them want to be interacting with people in the office in person.
That's good to know.
To me is a good sign.
Yeah.
And I actually think that some are doing a mix, like Northwestern Energy is doing a mix of that.
Most are doing a mix, I would say.
They are like, you can work from home on Monday, you can work from home Friday, but you need to be in because of that interaction and the need for that. So I'm seeing that.
Okay, so I don't like this happening to me, but we're behind schedule.
All right.
So we'll move to page 39. We have made 2 commitments since last we met with you. DRA Growth and Income 11, Stockbridge Value Add Fund 5. I'll turn it to Rob to cover DRA and I'll talk about Stockbridge. And we'll move fast.
Right, so DRA Growth and Income 11 was committed, staff committed 50 million on April 5th. As you can see, this is a long-standing relationship that MBOI has had for going on 16 years now with a firm that is very cycle tested, and between its hands-on investment, asset management skills, culture, and quite frankly, the willingness it has to learn from lessons from previous deals, we continue to hold them in a very high regard. That said, Fund 11 is going to continue to do what they've done in the past, in that they're going to focus on investing in multifamily, industrial, retail, and office properties at attractive prices and aim to deliver the majority of the returns from cash flow. I'll put an asterisk on the office side of things and say that high quality office. So they're going to focus on the flight to quality that we've been seeing in the market. Any questions there?
That office thing made me a little nervous, so thanks for clarifying.
So Stockbridge Fund 5, we've been with Stockbridge since 2012. We've invested in their entire value add fund series, focus on the 4 major food groups, office, less than 10%, only in distressed opportunities and only quality office. And frankly, Fund 4 had 0 office exposure and Fund 5 they've got this little optionality, but I don't expect any to populate. Multifamily industrial retail, which is grocery anchored retail. They've been a great partner. Terms were very attractive. Team's been stable, growing, conviction remains high. Questions? Okay, we'll move to real assets. Again, similar slide here. Here's our exposure, value add over time, performance. John noted, in subsequent periods, we'll see this pie chart populate with trust fund and state fund ultimately. Had limited room here for bullet points, but they speak for themselves. To the extent you have any questions on the portfolio or any of these bullet points, manager specific questions, I will address them wholeheartedly. Okay, seeing none, we'll cruise over to the next page. The only thing I might point out here is the domestic versus international exposure. I would expect to see the international exposure here just grow through time incrementally, just given some of our existing relationships that have a global mandate, and the fact that conviction remains high there. A couple of them are back in market, and will likely close a couple of additional commitments in global infrastructure this year. So expect that to rise, and then obviously infrastructure will move from a 0 to 50 to a 25 to 65% range, which I fully am supportive of. So thank you again for that. Any questions here? Seeing none, we'll flip to the next page, 42. Again, just given sort of the exposure we have to oil and gas and timber in the portfolio, it makes sense to put in these price charts. I'm happy to put in other valuation metrics to the extent you have suggestions or would like to see something else. But oil's volatile. There's a lot going on in the oil market here. Saudi Arabia just came out the other day and put something out there about warning the shorts that they might cut production next week with a surprise announcement. We'll see. Lumber prices have come back down from their historic levels. Happy to answer any questions. Seeing none, that brings us to commitments to date. Talked about Kimmeridge Fund 6. I'll turn it over to Rob to cover some more specifics.
Yeah, so on Kimmeridge Fund 6, it was on March 1st that staff committed $50 million to this fund. This fund has pretty solid terms and is our third investment with this group, and is a manager that we really like. They're a vertically integrated group with deep technical experience and expertise, and are led by a management team with long histories and deep knowledge in many areas across the oil and gas space. As previous funds have done, Fund 6 will focus on investing in high quality, low cost, unconventional oil and gas assets and operating and developing them accordingly in the United States. And then as we discussed both yesterday and today, we're very bullish on this sector, given the capital flight and the fact that this stuff isn't leaving for many decades to come. So.
Can I ask about that first fund? It's 17, so it's been a while.
Yeah.
The IRR is low. Or
so I'll touch on that. So that's obviously suboptimal how it is now. When we have discussed this with management and monitored this fund through time, as we discussed yesterday, that this was and is largely caused by a large position they have in the Powder River Basin. This was a position that they deployed capital in. COVID hit, and they weren't able to really put forth the business plan that they wanted to exercise and then exit it as they thought that they would to. So they've been forced to hold on to this asset for longer than they thought. That said, they're currently in talks with a major oil and gas company to develop a joint venture that would allow them to make this holding very accretive to the overall fund. And we're very confident that they'll do just that, whether it's via this joint venture or some other way.
okay, thanks.
Okay, thanks everyone.
Good morning, but we're past noon. Mr. Chairman.
Does that mean you buy lunch?
I could if we stop now, I'll go buy lunch.
Making promises you can't keep.
Well, let's see, if I can pick lunch, then. Yes. So we'll be brief. Private investments portfolio, just a quick overview. I'm on page 44, behind tab 8. You see the breakdown here, so keep in mind that private investments portfolio is only in cap, only in the pension, not in trust or other portfolios. You see the performance on the page. It's very strong, continues to be strong. We're happy about it. And similar to comments that have been made already by John and others, we'd like to focus on the longer time frame. These are 10 to 15-year commitments, investments, very difficult to value on a 1 year or 3 year basis or shorter than that. So the one note I'll make on that little bar chart there, the value added on the 1 year looks like a tiny little blip there, but it actually equates in dollar terms to roughly 3 months worth of benefits payments. So it's, it is definitely accretive to the portfolio. We're happy about that. Unless there are any questions, I'll keep moving on.
What's this amount? What's the total amount there?
About 2.3 billion in assets currently. Yeah, and we'll add some numbers to that. I'll flip to page 45. Top half, really the breakdown of the portfolio in 3 major sub-asset classes that we look at: the buyout, venture capital, and private credit. The venture capital and buyout, that's really the equity exposure, if you will, in that portfolio. We believe it is one of the growth drivers of the pension plan. So we will traditionally hang around 70–80% in that equity exposure and supplement with some private credit, more cash flow, yield-focused strategies to help with the benefits payments. I have to ask for your understanding. The title of the chart on the left should actually be private investments, not real assets. The breakdown is the correct one. And maybe just one note on domestic versus international. It has traditionally been, currently is, and most likely will continue to be a more US-centric portfolio. We do have the ability to have international exposure, which we have done successfully. It'll be somewhere between 20 or 30% of the, and we have a couple of new commitments that actually fit in that bucket. We'll touch on later. Moving on to page 46. Again, we try to give you an understanding or an idea of valuations. Whereas the market in this particular asset class, it's not as easy as public equities where you can look up in Bloomberg PE values and so forth. So we try to look at deal volume, deal activity in the market. So that's the top left-hand chart, where we see how many deals are getting done per year and how much money gets deployed. See a large blip there in 2021. It was really a catch-up, amped up demand, that was the word I was looking for, from the pandemic years, where a lot of folks, like John pointed out yesterday, a lot of LPs hit the brakes and just stopped committing. So therefore, the deal activity went down pretty significantly during that time period. 22, more in line with expectations, some moderate growth there. We are currently in the first quarter 2023. That's the tiny little bar there. It's just 1 quarter. Slightly behind the average of the pre-pandemic years. Also not unexpected based on Jim's comments earlier. Actually, cost of capital is impacting everybody and everything. So the deal activity has dropped a little bit. Not a major concern on our parts. The good deals are still getting done, but certainly a slowdown. The right-hand chart, just a quick touch on valuations, if you want to call it. We look at purchase price multiples. So that how much is the manager paying for a company they're buying in terms of EBITDA. That has also come down slightly from historic highs. Not a dramatic devaluation, but certainly a cooling off in that regard. The bars in that chart is your debt debt usage or leverage on these individual deals. Keep in mind, these are the average headline numbers. So when you look at our portfolio, by design, our managers tend to be 1 to 2 turns lower than these numbers, i.e. more conservative in the use of their leverage. And that, for obvious reasons, again, as Jim has pointed out, I don't want to keep repeating the same thing, but interest rates rise is certainly a major factor here, that folks are restructuring their deals differently and not using as much leverage anymore.
But if I could add also, the 2023 4.2x is why it is unwise to simply call a halt to investment in privates, because that lower valuation may prove 5 to 10 years from now to be a year in which investments made by private GPs turns out to be a great vintage year. We don't know, but we do know that they're buying companies for less than they were 2 years ago.
Great segue to the next slide. Thank you, Jim. 47, our fiscal year to date, new commitments, and really just to give you a little bit of context there, we try to deploy on average 400 to 500 million per year across, on average, 8 new commitments. So you see we're right on track here. We have 7 new commitments year to date, fiscal year to date. We'll talk about the last 4 here in a second. And we have 1 more in the pipeline that should close out before the fiscal year ends, which put us right at 8 deals and 480 million or so committed. With that, I'll hand it over to Ian, who's going to touch on our new venture capital commitments and foundation accolade.
Good afternoon, everybody. I'm Ian Horwood, Senior Analyst on the Private Investments team with Thomas here. So I'm the venture capital guy. Had a couple of commitments to update you on that we've done this year. Foundation, Capital, and Accolade. So just starting with Foundation, this is a re-up to a manager we know well. You see in the board brief there that we've invested across funds 9, 10, and now 11. We also invested into their Leadership Fund 4, so 35 million to Fund 11 and 15 to the Leadership Fund. Fund 11 invests into high growth, early stage companies across enterprise software and fintech, and to a much lesser extent, blockchain. Whereas Leadership 4 is a follow-on fund. It's about half the size of Fund 11, and it allows the manager to invest in later rounds with some of their best ideas from the flagship fund. So it gives them some optionality to continue investing in companies that they have high conviction in. So a little background on Foundation. It's a well-established firm founded in 1995. They're on their 2nd generation of partners now. We like them because they're sector specialists. They tend to really stay in their lanes of enterprise software and fintech. Allows them to be really technical, know the space, be really well networked with founders. Really helps the brand name. So if you're an entrepreneur working on software or fintech, they're going to be one of your first calls. So we like that about them. Also, the early stage focus, 80% of their companies they invest in are pre-revenue, so no sales yet, and they'll invest in either the seed round or the Series A. So these are very early. We like that just because the risk return profile we think is more attractive. You can get in at lower valuations before the business model is really proved out, and therefore potential returns could be higher too. The other reason why we like the early stage is that you can buy a lot of ownership at that valuation level, and Foundation is targeting about 15-20% when they're going into companies. So if there's a meaningful valuation or IPO, that's really going to move the needle for the fund because they'll own a large percentage of that company. So those are the 3 reasons we really like them: sector specialist, early stage, high ownership and entry. And kind of more broadly, that's how we view venture capital in general when looking at other funds as well.
When you have on here industry sector, there's a word that says crypto.
Yeah, so
I always like to say we're not in crypto.
Yeah.
Explain that, please.
Yeah, happy to touch on that. So roughly about 10% of their fund they'll do in, I'll call it blockchain just because it's more encompassing. Like, yep, crypto is definitely a part of that sector. So basically, what they're not doing is they're not trading tokens or cryptocurrencies. They're really investing in infrastructure projects. Let's say exchanges. So they're really kind of more on the nuts and bolts side of it rather than speculating on Bitcoin or Ethereum. And they've had a lot of success doing this. Fund 8, unfortunately, we were in Fund 9, so we're not in this, but they did invest into a project that was built on top of Ethereum, which is a crypto platform, and that returned the entire fund and in cash as well. So, I mean, what's fund data? It's still at like 6 or 7x.
Yeah, that's a 6x, I want to say.
So, but really, they're mostly doing enterprise software. So and fintechs. We're talking about mobile banks and software that help enterprises be more efficient. You know, whether that's HR or some type of AI angle to improve a business process.
Yes, it's more the application of cryptocurrency, for example, not the actual trading of currencies and tokens. So we're not touching.
So we're in blockchain, we're not in crypto.
Yeah, I think you could continue to say that we're not in crypto.
Good.
That would be an accurate statement. Before I move on to Accolade, anything else about Foundation?
Just wondering why the fee is so much higher on 11.
Yeah, so that's the flagship product. And when I say flagship, I mean it's the main fund that they're offering. It's 2.5. It's a pretty high rack rate. When you look at venture capital, though, it's usually what a skilled manager will charge. That's just kind of the normal fee. Whereas in buyout, you might see more 2%, and even on some bigger funds, they might even charge 1.8, 1.85. So venture capital is an expensive asset class. But then probably more to your question, the leadership fund is a little less, I think it's 1.25. So that's really, they're just following on, investing alongside other venture companies at later rounds. So it's really a lot less work for them. They already know the company, they back them early, and it's really just excess capital for them to continue backing their companies. And so it's really, so this is the work level for the company that is reflected in the lower fee.
Just gonna add a comment there. We're very fee conscious and try to negotiate heavily on that, and that's why you'll not see venture capital be 80% of private investments, knowing that it is a more expensive asset class. The 2.5% is middle of the fairway for venture capital, not for private investments. It is on the high end for us, and that's why it'll always be a smaller allocation. We like the risk return profile that should add to the portfolio.
Okay, nothing else on Foundation. Moving on to Accolade. So super excited about these guys. It's a new manager, new relationship with BOI. It's a DC-based fund-to-fund that invests in venture capital and growth equity. So they invest, they make fund commitments in funds that are typically too small for us to invest in directly. A lot of their funds are actually 30 to maybe $70 million in fund size, where we like to write checks that size, so that's not going to work. So beyond being too small for us, there are also a lot of oversubscribed managers, especially in venture capital. It's pretty common to see once a venture capital firm has some success, they don't need new LPs, and they're hard to access. So you might ask, why go the fund-to-funds route? Just for some context, you saw a little bit earlier, venture is a pretty small part of our portfolio. It's about 12%, and we're only actively re-upping with 2 venture capital names directly. So just kind of looking at the market, just came to the conclusion that it's just a much more efficient route to go. We can write a $50 million check and get a diversified pool of venture capital names, especially ones that wouldn't take us directly as new LPs. So yeah, a downside there with the fund of funds model is the double layer of fees, which I'll touch upon. So we're paying Accolade a fee, and then Accolade is paying fees to their managers. So there's 2 levels there. However, we looked at the market last year, talked to about over 10 of Accolade's competitor, and I'd probably put them in the lower third as far as fees for a venture fund manager. Also, we invested in 2 vehicles, Fund 9 and Venture 1, and I'll go into those each. Venture 1 doesn't have a management fee, so that's pretty attractive. But beyond the access to oversubscribed funds, there's a strategic partnership here as well. Accolade has a history of working with institutions to help them build out direct relationships with funds, and we're planning on utilizing that and using them as thought partners. Thomas and I, we see a lot of different pitch decks for different funds, and they've already been really helpful in sharing notes and letting us know their opinions on research that they've done. So that we're going to definitely utilize that partnership. Almost view them as like an outsourced, venture part of our team.
It's to the sourcing part of the investment process that Ethan and Rob went through yesterday. So it's just another source for us to get in front of new managers and uncover new opportunities.
Yeah, exactly. So then just getting into Fund 9, the actual funds we invested in, we did 25 million in Fund 9. They closed on 500 million. They're going to invest in 20 venture capital and growth equity names across the 2022 to 2024 vintage years. Well, we're not timing venture capital. We think this is a permanent part of our portfolio and would like long-term exposure to it. But it's just kind of interesting to point out after last year's market correction, especially in tech and venture capital, I think the next few years are going to be some pretty solid performers. Accolades Fund 3, which is their 08 vintage. So they invested that fund post-crisis, is sitting at a 5x net right now. And over 3x of that has been distributed so far in cash. So we think this is a pretty good time to do it. So that's Fund 9. We also did 25 million to Venture 1. So Venture 1's really an overage vehicle for Fund 9. So whatever allocations that don't make sense to go into that main fund from a sizing perspective, one of their managers might give them too much allocation that they don't want to all put in that Fund 9. They're just going to funnel all of that to Venture 1 and then not charge a management fee on it. So we think that's really attractive. They've been in business for over 20 years. They were founded in 2000, and they've been really disciplined about their fund sizes. And so that's one way that they've done that is by whenever they get more allocation that doesn't make sense, they'll divvy that out on a one-off basis to LPs. But now they put it in this fund structure that doesn't have a management fee. Charges carry, we think that's well aligned with LPs. The only way they're going to make money off of this is if it's profitable. So we're okay with that. And so if you look at our $50 million commitment split across these two funds, we're only paying management fees on half, which we think greatly reduces the double layer of fee issue that is presented with the fund. So I'll stop there. Any questions about Accolade or Venture more broadly?
This is Becky. Just a note that we have other clients that use this organization for the very same structure reasons that you made that decision. So I just wanted to mention that. And we know Joelle fairly well from having longer term relationships through clients with this fund. So I just wanted to mention that.
Cool. Good to hear. Thanks, Becky.
Just to add, it wasn't a lightly decision. As Ian pointed out, we went through probably 6 months of evaluating multiple 12, 15 fund-to-fund specific providers and settled on top 2, ended up going with Accolade for exactly these reasons. I'll move briefly on to the last 2 commitments that we've done so far. One of them was Axiom Fund 7. Also a re-up for us, a very long-standing relationships with Axiom for almost 14 years, committed to 6 of their funds. Axiom is also a fund-to-fund manager, it allocates to managers primarily in small-sized buyout, growth equity, venture capital across the Asia-Pacific region. So think Korea, Thailand, Vietnam, Malaysia, Singapore, these type of geographies. Again, I have to ask for your understanding here. We are still working out some of the kinks of our new system, and the performance that you see for the existing funds is actually wrong. Apologize. I will gladly follow up with the corrected version, which is much higher than these numbers that you see on this page. Just wanted to point that out. Axiom, we really like the firm as well. As I said, 14-year relationship with Montana, strong team, very strong expertise in the local markets that we, as Ian and I sit here in the US, we certainly can do a lot of damage in this country in terms of sourcing deals across Asia Pacific is much more difficult for us with travel budget, time constraints and bandwidth, so forth. So we had made the decision years ago to outsource that majority of that work to Axiom and help us make, similar to the venture model, introductions to standout individual managers, and at the same time we keep committing to their funds, which are very successful.
On their law or jurisdiction, it says Cayman. Is that a red flag at all?
That is not a red flag at all, actually, is most of the Asia managers, or yeah, Europe would be Luxembourg, but most of the Asia Pacific region managers, they have their law housed in the Cayman Islands, which is very well known for that. And we do actually reference checks with the representatives of these law firms and so forth. And it's not a red flag at all. It's just more cost efficient and simpler for them to do it in the Cayman Islands versus in 6, 7, or 8 individual jurisdictions where the fund actually invests in. So that's why.
It also reflects British law as its core foundation. Would you feel better if it was Indonesia or Malaysia or Myanmar?
So Cayman Islands still a British colony to the States.
Does that mean that's where you're gonna travel next?
No. No. That was quick.
Oh, that was an easy one.
I have been to the Cayman Islands. It was actually pretty nice, but.
Great diving there.
Would the
Yeah, great
director
scuba
need to
diving.
go?
It's good. If there are no other questions, I'll move on to the next or the last one. That is OCP Fund 5. Also a leader for us. We've been in 3 funds with them now, 4 funds, excuse me. The performance on this page is correct. I wanted to highlight that as part of the private credit bucket. So we underwrite that with very different return assumptions, more a cash flow, yield focused type strategy, similar to what Ethan was talking about yesterday in real assets. So we don't expect 20, 30% IRRs in this strategy, more in that 8, 9, 10%, maybe a little bit higher. Currently, we are more on the higher end with interest rates doing what they are doing. So we feel very, very good about this commitment here and taking advantage of the higher interest rates. OCP also invests in a similar region, Asia Pacific, Southeast Asia, Australia, New Zealand. Does primarily sole control lending to small family businesses, mid-sized enterprises. One of their most recent commitments, just to give you an idea, was a loan to a Malaysian trucking and logistics company. So very, boots on the ground type businesses. That's what they are lending to. Very happy about the terms. We always negotiate on fees, as I mentioned, so we were able to get a small discount here. Technical rate for the investment period, for after the investment period would be 2%. We got it down to 1.75. In the long run, on the $50 million commitment, it will make a difference. I'll stop there and see if there are any questions. See none, then I'll clear the seat. Thank you very much.
Thank you.
Feel free to talk a long time.
Well, you can count on me, Jack, but given that both John and Jim and Jason spoke eloquently and exhaustively on fixed income, maybe I'll just refer the board to slide 51, please, if you would. Just wanted to maybe give you a flavor of where we're going in fixed income. You might notice the duration of this portfolio was almost exactly on top of the index. We started this the 1-year period at about 90% of the index, so we were short. We got to neutral. That is why we had moderate outperformance to the index. Our intention is to continue to lengthen the duration. So you might rationally look at that and say, well, if your yield to worst is that high and you have a inverted yield curve and you intend to lengthen duration, doesn't that suggest that you possibly could underperform the index over a short period of time? And that is true. And that's the risk that we intend to take in the hope of locking in higher interest rates for a longer period of time. Additionally, you might look at the contribution to duration from corporates or your risk to corporates and say, well, you're equal to the index. I think Jim pointed out the possibility of what the Fed did causing a recession. Spreads can widen in and around a recession, so why be neutral there? Why not be short? And the answer is because the timing of that is very difficult to predict. But if it does happen, we would intend to fully take advantage of it in overweight corporates if spreads widen. Other than that, just a few observations. The board was interested a little bit in exposure to energy. For the portfolios, we are about equal to the index in terms of our exposure to energy. We are significantly overweight refining and significantly underweight exploration, production, and development. And that is more of a call on specific companies, to wit, borrowing money to buy back shares. You know, when you borrow money to buy back shares, you're not borrowing money to buy assets that will produce income to pay us back in the long run. So that is the only reason for those differences. Yeah, and then I'll just ask for any questions, and if not, I will respect your time.
Any questions? Well, no bad news, really. So good job.
Well, I don't know, there was a minus sign in front of those returns.
I knew you'd bring that up. Anything else? John, anything for the rest of your?
The only thing I would add maybe is just for all the board members really, I guess, is, don't feel like this is your only opportunity to come and ask us questions. We are here every day and you can come in and, ask me questions or any of these guys who've been up here presenting, and we're happy to explain things because I know it gets pretty deep in some areas, so please feel free.
Well, I want to compliment all of you. I like when there's a lot of individual presentations. They were all excellent. So thank you. So we'll move on. Recap of to-do list. I think, Dan, you got a few things.
So so everyone can get on the road, I will send out just a general inquiry, what dates don't work for you for a visit to RBK. September's out, but we'll sort of shoot for that October timeframe if that works for folks. October. We will, at the same time, I'll get your availability for a quick IPS meeting based on legislative action toward the end of June. We owe the Trost tequila measurements on the glass half full office space analysis, and then we'll get you the correct Axiom performance from the new commit. In the meantime, I will be working with our multifamily developer pro forma on the workforce housing component of 819 and get something out to all of you sooner rather than later.
Anything else that people would like Dan to focus on? You got it covered?
All right.
Anything else we need to do from anybody? If not, meeting adjourned.